The election results are in, and if you're planning to purchase a home in 2025, this is what you should expect. Brand the Mortgage Man here, and I've helped more than 10,000 home buyers over my 22-year career, putting me in the top 1% of loan originators nationwide. And because of this, I understand the importance of knowing what you're getting into before making the life-changing decision of becoming a homeowner. In this video, I'm going to discuss what the home buying process looks like step by step, how much you should save for a down payment, new loan programs to help first-time home buyers, and what industry experts are expecting to happen with home prices and interest rates in 2025. So let's get into it. So let's first go through the step-by-step process of home buying. First thing you want to do when you're planning to buy a home is you want to assess your finances. You want to review your budget and savings to determine how much you can afford to spend on a home. Then you want to check your credit score, as this will affect your ability to secure a mortgage and the interest rate you're going to receive. You also want to consider how much you can put down for your down payment. It's going to be typically 3% to 20% of the home price. And you want to budget for other upfront costs like closing fees, inspections, and moving expenses. The second thing you want to do is get pre-approved for a mortgage. So once you've budgeted, then you'll be able to have the conversation with a lender to get pre-approved. And you want to approach a lender or mortgage broker to get pre-approved for that mortgage. It's going to involve submitting financial documents such as income documents and asset documents and having your credit pulled for evaluation. The lender is going to assess your financial situation and give you a pre-approval letter indicating the loan amount you're eligible for. The pre-approval will help set a budget for your home search and shows sellers and realtors that you're a serious buyer. Next, you want to hire a real estate agent. You want to find a real estate agent who can guide you through the process, help you find homes that match your criteria, and negotiate on your behalf. Real estate agents are familiar with local markets and can provide valuable insights and access to listings. Next, you want to start house hunting. You want to begin viewing properties that fit your needs and budget, whether in person or online. Make a list of your priorities, the number of bedrooms you want, the location, specific school district, and then share that with your agent. Visit multiple properties to get a sense of what's available in your price range. Once you find the right property, you want to make an offer. You want to work with your agent to craft that offer. The offer is going to include the price you're willing to pay and any contingencies such as home inspection, financing, and appraisal. The seller can either accept, reject, or counter your offer. If they make a counter offer, you may negotiate the terms before reaching an agreement. Once under contract, you'll schedule a home inspection. And you'll schedule this to identify any potential issues or repairs that may need attention. If the inspection reveals significant problems, you can renegotiate the price or request repairs or even walk away from the deal, depending on the terms of your contract. Once you've done that, you want to finalize your financing. Now that you have a signed contract in place and you've made it past your inspection period, you'll definitely want to contact your lender to finalize your mortgage. And this may involve providing additional updated documentation. The lender will conduct an appraisal to ensure the home's value aligns with the loan amount. You'll lock in an interest rate if you haven't done so already. Next, once you've gone through the mortgage process, gotten your appraisal and everything's good, you're going to be moving toward the closing. And you're going to want to review your closing documents. You'll review all paperwork related to the sale, including the loan agreement, inspection report, title report, and closing disclosure, which outlines your final closing costs. Make sure all of the terms are correct and you understand the total costs involved. And finally, you're going to close on the deal. On closing day, you'll sign the final paperwork, including the mortgage documents and deed of trust, transferring ownership of the property from the seller to you. You'll pay closing costs, which typically include fees for the loan, inspection, title, insurance, and more. Once everything is signed and the payments are made, you'll receive the keys to your new home. And then it's time to move in and enjoy that new home. After closing, you're officially the owner of the property. It's time to plan your move-in, set up utilities, and start making the house your home. By following these steps, you'll be well on your way to buying a home and securing your place in the housing market. Now, how much money should you save for a down payment on a home? Well, when buying a home, the down payment is a significant upfront cost that typically ranges from 3% to 20% plus of the home's purchase price, although the exact amount you'll need depends on the type of loan and your financing situation. So here's a breakdown of what you should know about down payments and the options available. So traditionally, 20% down payment is what's talked about. That's historically been the standard for conventional loans. A 20% down payment offers several benefits, such as avoiding PMI and potentially securing a better interest rate. However, it requires substantial savings that not everyone has. For example, a $300,000 home, a 20% down payment would be $60,000. So there are lower down payment options of 3% to 10%. Many home buyers, especially first-time buyers, can qualify for loans that require a smaller down payment. For example, if you're buying a $300,000 home with 5% down, you'd only need $15,000, just a quarter of what would need it at 20% down. Though these options may come with added costs such as mortgage insurance or PMI, which protects the lender in case you default on the loan. Now, let's talk about some down payment options based on the type of loan you're getting. So let's talk about conventional loans first. So on conventional loans, the down payment ranges from 3% or more, right? A 3% down payment is allowed on some conventional loan programs. So if you're a first-time home buyer, you can do 3% down, or if you qualify for Fannie Mae's Home Ready or Freddie Mac's Home Possible, those also allow you to put as little as 3% down, even if you're not a first-time home buyer, if you meet certain income and credit requirements. So this is a good option for buyers who may not have the full 20% saved, which is most. 5 to 10% down payments are available for many buyers, and they opt to do that, especially if they're able to secure a competitive interest rate and are comfortable with the added cost of PMI, mortgage insurance. Mortgage insurance applies when you put less than 20% down on a conventional loan, but it can be removed once you've built enough equity in your home, which is usually after reaching the 20% equity mark. Now, an alternative to conventional is an FHA loan with a minimum down payment of 3.5%. So if you're looking to buy a primary residence and want to put less money down, right, 3.5%, maybe you're not a first-time home buyer. Well, FHA might be a good option for you. FHA loans require that minimum 3.5% down, which is lower than what you're seeing for most conventional loans, as I mentioned. However, FHA loans require mortgage insurance, which add to the monthly costs. They have both an upfront mortgage insurance premium as well as monthly mortgage insurance, which stays with you for the life of the loan. Next is a VA loan. If you're an active duty military or you're a military veteran, you may be eligible for a VA loan, which requires no money down, right? So as I said, if you're a military veteran or active duty service member, you may qualify for a VA loan, which offers that zero down payment, which can be a huge advantage if you have limited savings. VA loans also don't require mortgage insurance or PMI, but there is a funding fee if you're not exempt. And now, to be exempt from the VA funding fee, you need a service-connected disability rating. If you're in the military or you're disabled, you would understand what that is. The fourth type of mortgage is a USDA loan, also no money down. And these are for people buying in a rural or suburban area, and it's offered by the U.S. Department of Agriculture. These loans are available to low to moderate income buyers who meet eligibility requirements based on location and household income. Now, some other things that you want to consider, right? Outside of the down payment, as I mentioned, you also want to consider the closing costs. So in addition to the down payment, buyers should plan to have closing costs, which range anywhere from 2 to 5% of the home's purchase price. Closing costs can include fees for the appraisal, home inspection, title insurance, government fees, lender fees, right? All of those things need to be considered, and that's on top of your down payment. Now, when it comes to the down payment itself, there are actually down payment assistance programs, and many states, counties, and cities offer them for first-time home buyers or those meeting specific income or employment criteria. And these programs can provide grants, loans, or tax credits to help reduce the burden of the down payment. The ideal down payment depends on your financial situation, loan type, and home price. So while putting 20% is the traditional route, there are plenty of options, as I've said, for buyers who can't afford a large down payment, such as the FHA loans, VA loans, or conventional loans with as little as 3% down if you're a first-time home buyer. So be sure to consider the long-term costs like PMI or mortgage insurance when choosing your down payment size and explore available assistance programs to help reduce your upfront costs. Now, there are some new loan programs that are out to help first-time home buyers going into 2025. So I'm going to talk about two of the hottest programs that have been released for first-time buyers that you may want to take advantage of. So the first is the Freddie Mac 100% conventional financing program. And what this is a program that allows you to put zero money down while using a conventional mortgage, which goes against the norm. And the way it works is you get a 97% first mortgage, meaning it's equal to 97% of your purchase price, and then you get a 3% second mortgage. But the second mortgage is at 0% interest with no payments required. Pretty awesome. So you're able to borrow 100% of the purchase price, meaning you're not putting any money down. You do still need money for your closing costs, but it's a conventional loan that you can qualify for. The second is the SPCP grant program through Fannie Mae. So this program is a Fannie Mae backed program that's based on your current address. You have to be a first-time home buyer. But if your current address falls within an area that makes you eligible for this program, not where you're buying, but where you're currently living, and if your lender participates in this program, they'll be able to check that for you. But it will give you $5,000 toward your down payment that you do not have to pay back. It will give you $500 toward your appraisal and another $500 toward a home warranty on the property. Now, on top of all that, you actually get a better interest rate and a lower cost of mortgage insurance if you're putting less than 20% down. So it's a pretty awesome program. Now, what are experts thinking that mortgage rates will look like in 2025? Well, my prediction is that we're going to see rates drop, and I expect to see interest rates in the low fives by the second half of 2025. But let's see what others are predicting. So, predicting the direction of mortgage rates involves a combination of analyzing current economic conditions, historical trends, and expert forecasts. So, while it's impossible to predict with absolute certainty, several key factors suggest how rates might evolve. So, the first are economic conditions and the Federal Reserve policy. So, Federal Reserve rate decisions. The Federal Reserve plays a major role in determining interest rates, including mortgage rates. So if inflation continues to subside and the economy stabilizes, many experts predict that the Fed could begin lowering rates further in 2025. And this can lead to a gradual decline in mortgage rates, although it's unlikely to return to the ultra low rates we saw during the pandemic. Second thing is inflation. Inflation is another critical factor. If inflation continues to be under control in 2025, the Fed might feel more comfortable lowering rates, which would likely bring mortgage rates down as well. However, if inflation pressures persist or the economy faces new challenges such as a recession, the Fed may choose to keep rates higher for a longer period. Next is just the housing market dynamics. Limited housing supply. The housing market in the U.S. has been facing a shortage of available homes for sale, especially in affordable price range. And this low supply, combined with higher mortgage rates, has kept home prices elevated in many areas. So even if mortgage rates decrease somewhat in 2025 as projected, the housing market could still remain competitive depending on inventory levels and demand. Homebuyer sentiment. If mortgage rates decrease by 2025, this could improve homebuyer sentiment and encourage more people to enter the market. However, given the many existing homeowners locked in lower mortgage rates during the pandemic, many of those might be reluctant to sell and buy again at a higher rate, which contributes to a continued tight supply of homes. So what are experts predicting for 2025 mortgage rates? Industry experts expect a moderate decline in mortgage rates in 2025, but not for them to fall dramatically. According to various forecasts, mortgage rates could potentially drop to 5.5% or 6% for a 30-year fixed by mid-2025. Like my projection, I'm thinking low fives, all the way down from the 7% range that we're currently seeing, assuming inflation is under control and the economy shows stability. However, this is still higher than historic lows seen in recent years. Now, expect gradual improvements. The rate of decline in mortgage rates will likely be gradual. As long as inflation remains a concern or the Fed needs to keep tightening monetary policy in the short term, mortgage rates may not dip significantly in the early part of 2025. A larger drop could be expected later in the year, rolling into 2026, once inflation is firmly under control. Now, there are risks and uncertainties with global events, and global economic factors such as geopolitical tensions, international trade, and supply chain issues can influence U.S. mortgage rates. Uncertainties around these factors could cause fluctuations in rates that are difficult to predict with precision. Let's talk about a recession risk. Some economists have raised concerns about the possibility of a recession in 2025, which could affect mortgage rates in unpredictable ways. If the U.S. economy enters a recession, the Fed might lower rates to stimulate growth, potentially bringing mortgage rates down. However, if inflation or other economic pressures persist, rates could remain high or even rise. While mortgage rates are expected to moderate in 2025, they are unlikely to return to the record lows that we experienced in the past. Experts are predicting that rates may decrease to around 5.5% to 6% for a 30-year fixed rate mortgage, as I said. This assumes inflation is under control and the economic conditions stabilize. However, the housing market's dynamics, inflation trends, and Federal Reserve actions will all play a key role in determining the exact trajectory of mortgage rates, making predictions uncertain. Buyers and homeowners should plan with some flexibility and consider locking in rates when they're favorable within the context of their broader financial plans. So, what is going to happen with home prices in 2025? Well, predicting exactly what will happen with home prices is challenging, as it depends on various factors, including interest rates, supply and demand, inflation, and broader economic conditions. However, experts have identified several key trends and economic forces that are likely to influence home prices in 25. So the first is slower price increases due to moderate price growth and stabilization. After years of rapid price growth driven by low mortgage rates and high demand and limited supply, many industry experts expect home prices to stabilize or experience slower growth in 2025. With mortgage rates expected to remain higher than the historic lows seen in recent years, affordability will continue to be a challenge for many buyers. This could lead to cooling in price appreciation, especially if markets where home prices have become out of reach for a larger portion of the population. Next are regional differences. While home prices may stabilize nationally, there will likely be regional variations. In high-demand metro areas like New York, Los Angeles, or parts of Florida where I live, prices might continue to edge up, though at a slower pace. In areas that saw dramatic price increases during the pandemic, such as some Sunbelt cities, price growth may decelerate or even dip slightly as the market normalizes. Let's talk about the impact on supply and demand and how that affects the prices. So let's talk about ongoing supply constraints. A significant factor influencing home prices in 2025 will be the supply of homes available for sale. As of now, the U.S. housing market is facing a chronic shortage of inventory, which has kept home prices elevated. While some builders are increasing production, they are still struggling to meet demand, especially for affordable housing. Additionally, many homeowners who locked in ultra-low mortgage rates during the pandemic may be hesitant to sell, further restricting supply. As a result, prices may not see dramatic declines, even if demand softens slightly due to higher mortgage rates. Homeowner reluctance is also important. Many homeowners with low mortgage rates are rate locked into their homes, meaning they may be unwilling to sell and buy again at current higher rates. This could keep the number of homes on the market limited, contributing to price stability or gradual increases, even in more challenging interest rate environments. Affordability constraints and buyer behavior is key. High mortgage rates impact affordability. While mortgage rates are expected to gradually decline from their current highs, they're still likely to remain above the historical averages experienced during the past decade. This will continue to impact housing affordability, particularly for first-time homebuyers. And as a result, many buyers may either delay homeownership or look for more affordable housing options in the suburbs or less competitive markets. This could slow the pace of price growth in some areas, especially in the higher-end market where fewer buyers may be able to afford homes. A shift in buyer preference is also going to be a factor, because buyers may continue to prioritize affordability over luxury or location, which leads to increased demand in more affordable markets and potential slowdown in more expensive regions. Cities and towns that offer lower prices and better value could see stronger price stability or even growth, while more expensive urban areas may face price stagnation or slight declines. Next is inflation and economic growth. Economic growth versus a recession is key. If inflation remains under control and the economy avoids a major recession, experts expect a moderate increase in home prices in 2025. However, if economic conditions worsen, such as a slowdown in job growth or a recession, home prices could see a decline, particularly in areas where the local economy is closely tied to industries that are more vulnerable to economic fluctuations. So about inflation and construction costs. High inflation and rising material costs have also affected the housing market, especially new home construction. Even if overall inflation slows, construction costs could remain elevated, which would keep new home prices higher. As new construction continues to be expensive, it will likely add upward pressure on the price of existing homes, especially if new inventory is not able to keep up with the demand. Next, let's talk about long-term market expectations. So first, we'll talk about gradual price stabilization. Long-term experts expect that home prices in many markets will stabilize or experience modest gains as the market adjusts to the new normal of higher mortgage rates. As the housing market cools from the extremes of the past few years, prices will likely adjust to be more in line with average long-term growth trends of around 3 to 5% annually, depending on local markets. Now, there is a potential for some price drops. In some overheated or overvalued markets where home prices have surged too quickly, prices could see a slight pullback as demand softens for the local economy slows. However, broad price declines are not expected, especially if supply remains tight. In 2025, home prices are likely to experience more moderate growth or even stabilize after years of significant increases. Affordability challenges due to higher mortgage rates, limited housing inventory, and regional supply-demand imbalances will continue to play a central role in shaping the market. While the market may not see dramatic price drops, certain markets could experience slower growth or minor price adjustments, particularly in areas that saw rapid price escalations. Nationally, prices are expected to increase at a slower pace, likely in a range of 3 to 5%, assuming the economy stabilizes and inflation is kept in check. However, as always, local market conditions will play a crucial role in determining the specific price trends for different regions. If you found this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages, and make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.